Welcome to the Financial Architects Podcast. It is a midsummer's night dream. I had to break that out there, but we are not in the middle of summer. July 4th is in the rear view mirror, and I am pleased to have partner and chief investment officer Larry Steinberg, as usual, join the podcast. So, Larry, halfway through the year, you made some predictions earlier in this year. How has your crystal ball fared?
My crystal ball was okay in some areas, but I was way off in others. Absolutely wrong on a couple items. I really thought that the Republicans were going to impeach Biden as retribution for all of the lawsuits against Trump. I thought that was going to be a big issue right now. And I also thought that the Republicans would have forced a battle over the budget, but they kicked the can down the road. So I was very surprised with it. I thought that they would want a budget battle in the middle of the election in order to, portray themselves as the ones that could fight inflation because they weren't going to keep on spending. But they, like I said, they kicked that can down the road. So I don't know.
Larry, what do you attribute being incorrect to?
It's either the Republicans have no strength and are just a bunch of whips and didn't want to fight, or it could turn out that they were absolutely brilliant to just get out of the way and allow Biden to be Biden, and and we don't know yet, right? So I don't know whether they were brilliant or wimpy, but I guess we're going to find out eventually.
Where are some areas that you've been correct? Give yourself some credit. Do it.
I am right in that the election has been dominating everything, right? So, the election has been, the center of everything that is going on, and that has been driving what's going on with the market. I really believe that. We've also got the fact I was right that Powell is boxed in on interest rates. He thought that he would have the data to be able to reduce them right now. And I still think that was politically motivated. And I still think he may do it regardless of what the data says. But inflation is running, much hotter than what they said it would. It wasn't transitory before. It's not transitory now. They're just wrong. But because Powell said, hey, we're going to let the data make the decision. And, even when they slice inflation to put it at its lowest, it's still like 2.5%. Reality is what people feel in their pocketbooks is much higher than that because they like to take certain things out because they're volatile. But those are also the things that seem to affect people's, ability to pay for things, which is energy and food. Right. So, the reality is that I was right that the election has been the big issue, and I'm right that interest rates, that Powell's boxed in interest rates, and he really wants to lower them, right? But I think what's interesting is if Powell decides that the election is lost, then he may not lower them, right? He may say that why would I, throw a lifeline or try to help somebody that's already sinking and, leave them more elevated, right? And so that he can say, oh, he just did what the numbers told him to do. I mean, the reality is Powell's been completely wrong. They left them low way too long. In fact, they goosed them, and they thought that increasing them would drop, would slow the economy. But that either was in ignorance of the fact that, when you spend $1 trillion at the federal level, Inflation Reduction Act and, Infrastructure Act, that when you're pushing that much money into the economy, that, you're going to have growth, right? It's not sustainable, but you push $1 trillion into the economy, things are going to go up. Now, the scary thing about that is if you look at those numbers, the amount of GDP growth that we get from that spending is negative, which means that we're taking on debt at a higher rate than the GDP that's produced. That's not good, right? So we'll see how that happens. And I was also right that, you're going to have these candidates lurking in the corners waiting for an opportunity to move in, right? I mean, we've seen that. I mean, that's on the news every day. But let's not forget still that there is Republican groups and Republicans hanging in the shadows, thinking that Trump may get forced out of this due to the the frauds, convictions, and all of that stuff. Whether you believe that's legitimate or not is irrelevant. The reality is that I get emails all the time from these Republican groups saying we need to be pushing Trump out and putting up a better candidate. And it's like, well, I guess polls don't matter to you, but I was absolutely right on the shadow candidates and the shadow campaigns that are being run on both sides. And I was also right that the banks and commercial real estate are very distressed. I mean, it's not, the Silicon Valley Bank and First Republican going down a year ago. That's not over. And workouts only go for so long. And then every day, if you're paying attention to commercial real estate, you're seeing in the big cities these buildings sell for under half of what they were, sold for a few years ago. Huge write-offs there on the loans and on the debt. And that's just kind of being pushed down the line. And, they're supposedly doing workouts, but at some point that you only can push that back so long. That's not going to work. So, that's, and the markets themselves looking at that and kind of ignoring it is kind of crazy. Although I will say this. Look, the stock market is doing great right now, but the credit markets aren't, right? And usually those go hand in hand. Like the credit markets are going to show strength at the same time, and the stock market is, because they're both dealing with the same economy. Credit markets are looking bad right now, right? You're looking at the spreads widening. You're looking at a lot of stuff happening there that should be very worrisome, right? Because even though there's this idea out there that we've had a soft landing, like they're literally saying we've had the soft landing, I don't really think that's true. And I think that if you dig into a lot of the statistics and how they're being revised, like employment numbers look good until you look at, they're always revising down the prior month's numbers, and until you look under the hood and look at, like, we're losing full-time jobs, right? Full-time gainful jobs are decreasing as a percentage, right? And the gig economy and people working part-time jobs are increasing, right? That's not really good. You want people to have full-time jobs with benefits. You don't want them, working 2 shifts at Walmart a week and then being an Uber driver. And then, that's what's happening in a lot of places right now. So we'll see how this plays out. But my economic thesis, investment wise, has always been, good times or bad, that you want your portfolio to be in things that will make money regardless of the economy. It can't depend on the economy, because one crazy person blows up something somewhere, anywhere in the world, and the economies will take, right? And, we're getting black swans every 10 years. And the definition of black swans, a once in a lifetime, and we're getting them every 10 years. I think it's really, really crazy right now. And, this all reminds me of the 2000s. I remember in 2005, I was like looking at things and saying, like, how can home prices go up? Like, this is massively unaffordable. This doesn't make any sense. This has to crash, right? I was right, but I was way too early. And by the time it actually happened, it surprised me, which was because maybe it's different this time, right? We're actually at a point in the housing market where it's the least affordable in history, right? But it's still going up, right? So eventually that can't stay, right? So, there's a lot of stuff going on in the world right now, and it is pretty crazy.
Well, what surprised you, Larry?
I mean, I was just alluding to the stock market pushing higher right now. Just seems to me to be, very tenuous, right? And it's a very, very narrow market, right? Like S&P 500, less than 10 names are the majority of that increase, right? So if you didn't have NVIDIA in your portfolio, you didn't make the market money. Now, granted, I'm never trying to match what the market does because, clients in the real world, if you say you're down 30%, but that's great because the market's down 40%, they still are going to feel really bad, right? And we've been through 40, 50% down years, right? I don't want to tie myself into comparing things to the stock market, but it's a very, very narrow market. The credit market has not followed. The credit market is very, very shaky. what's also surprised me a lot is that the cryptocurrencies, that Bitcoin and Ethereum haven't gone up in price, right? You open up ETFs to Bitcoin, it's going to be opened up to Ethereum, and massive amount of dollars flow in there, and it goes down, right? It goes down. You would think that regardless of the fundamentals or your belief in the crypto market, and that's another segment to talk about, but it's gone down, which tells me that if all of this individual investor money, billions of dollars is flowing in, fastest ETF launches in history on multiple funds, and it goes down, that means people are selling, right? It's a zero-sum game. If a market goes up, it's because more people are buying than selling. If it goes down, it's more people are selling than buying, right? So if it's going down, that means more cryptos being sold than bought. Well, that tells me the established players, the people that are sitting on a lot of it, are selling to these ETFs. What does that tell you about the long term of the market? We'll see.
Well, I got to admit, not to get off on a tangent here, but I liquidated my Coinbase account a few months ago. I lost money overall over the course of a couple of years. Another one, and again, these are different issues, but around 2018, bought some, not huge money, marijuana stocks that became virtually worth nothing. Zero, like that went down to zero. So I just said, as far as the cryptocurrency goes, that I don't really know why the hell this goes up or this goes down. I don't really understand it that much, whether it's Ethereum or Bitcoin. It's very volatile. Yes, if you can stomach losses, you can make money. I have friends who have made money, but it's just too volatile is my takeaway. Maybe if I was in a different space with my income, I would have a different outlook.
A number of years back, I, as an experiment, put 10,000 into a bunch of different coins, right? And I've just let it ride since then. And that 10,000's been like over 50,000, and it's been down to under 2,000. And I haven't looked at it, but you're right. But the whole thing about cryptocurrency and like the very short version of it is, if it gets adopted and enough people are using it, then it, like the argument that if 1% of the total value of the stock market ends up in crypto, like it's a huge market and it'll make money and it'll be around for a long time. And then, the argument against it, like it's just what people are willing to buy or sell it for. If people aren't willing to buy it anymore, it's not worth anything. Just like you saw some of the, non-fungible tokens and, name, image, and likeness, people were paying big money for, virtual real estate. It's worth nothing now because, everyone's going to go there, and people eventually are like, what am I buying? Right. So
I did put money in an REIT. You know what an REIT is? I think it's a real estate investment trust. I put at the same time, this is small money, $500, but it's worth about $800 5 or 6 years later. That's not terrible.
Well, plus you got the dividend. No, we use REITs very extensively, both public and private. And, there's good and bad there, but, it's a good structure. One of the nice things about REITs is they're required to pay 90% of the income through. So unlike other companies that might just, sit on the money and pay it out in bonuses to their employees, right? REITs have to pass it through. So no, we're very large users of them in both the public and private. And it's a good vehicle, especially for income.
Where have you been spending? I know you've come on here on the Financial Architects podcast, talked about alternative investments, ETFs. Where have you been spending your time trying to move your clients forward?
So the higher interest rate environment has, the joke is our cupboard is bare. It's not quite bare, but we've got a lot less investments on our alternative investment platform now than we've had in the past, because higher interest rates make things more difficult, and things that may work in a lower interest rate environment aren't going to work in a higher interest rate environment. But it's also created some more opportunities. You can also get higher fixed payments in certain things than you could before. So spending a lot of time making sure that we had enough options there, because one issue that you run into is diversification, right? So you need to keep clients diversified no matter what. And if you don't have as many offerings on your alternative investment platform, that makes it more difficult to be diversified. So we've been spending a lot of time on what we have available. And, that's meant more conferences and more, trips for me. But, you got to do what you got to do, right? You got to provide the opportunity. So it's creating some new options, but it's wiped out a lot. There's a lot of guys that we use for years. We don't have their current offering on the platform because we don't have enough confidence they can perform in a higher interest rate environment. Then, when we have the questions about how you're going to do it, we don't get the right answers, especially in real estate. We have a lot less real estate offerings right now than I've ever remembered having, at any point in my life. It's just the cupboard is kind of bare, but I do have a lot of confidence in the ones we're using. But, there's a lot of stuff going on right now, and you've got to, kind of do your own way to stress test things in this environment. And you've got to look at it like, even if there's only a very low chance of things tanking, you got to be prepared for them to tank. Right. And, we do, and especially now, because I think a couple things people need to fundamentally understand is that, number one, interest rates, I think, even if they cut them, they're still going to be a lot higher than they were before. And at the end of the day, the biggest thing is how much the government bonds can have to pay in order to get investors. And that's going to be a big deal because the higher you have to pay to get people to invest in U.S. government securities, the bigger the drain on the budget, and that trails through to a lot of other things. And, the government has predicted that the deficit, not the debt, but just the annual deficit would be lower this year, and the revised numbers are higher. And some of that is because of they're having to pay a lot higher interest rates. So just because the Fed cuts interest rate doesn't mean that people are going to go out and buy a U.S. Treasury at 2%, especially if they see inflation is sticking around, and I think it's sticking around. So, you got to be focused on that. And you just have to have a fundamental, deep understanding that no matter which candidate wins office, inflation is not going down and the budgets are not going to get better, right? You're really looking at tax and spend versus cut tax and spend. And both of those have their problems. And, we don't have a fiscal conservative coming in that's going to clean up the government's balance sheet. We just don't. And probably because that candidate won't win. The candidate that's like Mr. Responsibility is not going to win. It just isn't. There's one thing we agree on in this country is that we want benefits, but we don't want to pay for them, right? So it doesn't matter what party you're in. You want somebody else taxed so that you can get your payout. It's just the reality of it. So we're not going to get a fiscally responsible government. And as long as we understand that, we have to operate in that environment, and we got to look at how that's going to affect inflation, and we got to look at how that's going to affect your investments. And like I've said before, I think the endowment model, we have a lot more, it's not that we're using that instead of the stock and bond market. We're using that in addition to. So we've got a lot more options out there with that. But that there's still, in tough economic times, and I think we are in tough economic times, it's not easy. And I do think that the economic disparities of rich versus poor are going to be exacerbated in a high inflation environment. And that's where we're going to be at for I think for decades.
What should investors be focusing on right now, this moment?
Well, you might be a little surprised, but I'm going to say it again. Taxes, right? The number one way.
Why would you say that with everything going on in the world presently? Your answer is taxes?
Well, yeah, exactly. I mean, the fastest way to economic independence isn't great investments, just to keep more of your own money, right? If you can do something and get a tax deduction or a partial tax deduction or a tax credit associated with it, if you can keep 20 or 30% more of your own money, right? That's, so if you can get a 20 or 30% tax deduction on something now, that's a 20 or 30% return. That's the equivalent of putting 20 or 30% more in your pocket right now. That's better than any investment out there that you have, unless, you bought NVIDIA and it goes up 500% or, Tesla or something like that. I mean, which happens, or crypto. But I mean, the reality then is even then when you go to sell it, you're going to lose half the taxes. So, kind of the reality of it is that people need to be focused on their taxes. If you can save money on taxes, that is the best way. That's why we look at it there. And the taxation system, you've got to use it to your advantage, right? You've got to take advantage of the loopholes and things that are there. They were put there for a reason. The reason may not be good, but there's no reason to not use it. If it's a legal tax deduction that the government has put in there because Congress voted on it, the president signed it, and the Supreme Court hasn't said it's unconstitutional, use it, right? Help yourself. Because the reality is paying more taxes is not going to help much. We got $30+ trillion deficit. Like, they're spending the money no matter what, right? So you might as well put yourself in the best financial position possible. And it drives me nuts when all these super wealthy people are arguing for higher taxes, yet they hire people like me to keep their tax bill low, right? So like, anybody that really wants to, help out the deficit and pay higher taxes, you can do it. You can write a check to the IRS and send it to them, right? So get off your high horse about what the fairness of taxes is. The only fair thing that people should be doing is putting themselves in the best financial position possible. Because if you take care of yourself, that means the government doesn't have to.
Wow, I did not see that coming, but knowing Larry, I probably should have. And that is a good time to wrap things up as Larry audited himself, where he was right, where he was wrong, where people should be focusing their attention, a podcast chock full of information. So for Partner and Chief Investment Officer, Larry Steinberg, I am your host, Evan Makovsky. This is the Financial Architects Podcast, and we will see you on the next episode.
Have a nice summer, everyone.